everybody. Welcome to each of you, and thanks for taking time out of your weekend to be with us today for this webinar. This is Craig at Max Trading. I'm here along with Chris and Eusebio, and we are really glad to include you in the Max community today, along with many others who will watch the video playback. And a number of our members are sitting in with us today. We're glad to see you as well. This is a really nice trading community, and many of you will be taking a Max course with us next month, November, and that will also give you a lifetime Max membership. So we look forward to associating with you for many, many years. The Max community is not only a place of fun and camaraderie, although that's important, but it also provides a ton of ongoing support and assistance, plus free trading workshops 2 or 3 times every month to continue improving your skills, and other benefits as well. As you know, the markets are always in flux. They're always changing. And new ideas sometimes can be very important to help us meet the challenges of trading conditions. It was more than 4 years ago now. Wow, time flies. Back then, Eusebio began to see the need for a reliable indicator to help deal with the changing flow of price in the markets. And so he began working and thinking and testing and developing, and the end result was the Max Enhanced Trade Format Indicator, which is a bit of a mouthful, so we just call it the ETF. This indicator has proven itself over and over again. It's a very effective addition to Max trading. So now we have added it to every level of Max training. There is no course available that does not include ETF, and that's been a great upgrade for our members. This means you can select any level of Max training, any course, and you will also get the very latest indicators, the ETF, along with the companion. The companion is our price direction bias indicator, and it can make a really big difference in trading results. And all of these things meshed together: proper training, correct price action analysis, effective indicators, supportive community, lifetime support. All of these things combine to give you a real shot at the kind of trading that will make a difference in your life. It is indeed an exciting time to get in on the Max system, to learn how to use it, and to take that first big step toward meeting your goals. Why would you want to make an investment in learning how to trade profitably? Well, I suppose it's a little different for each one of us. It could be a genuine need for a source of extra cash every week, or you may want to help a friend or a relative, or there may be some worthy cause that has caught your attention, and you can just sort of imagine yourself being in a position to help significantly. In fact, we even have 4 pastors that I can think of just off the top of my head who became Max members to help support ministry projects for their church. So it could be a variety of reasons, but Max is the place to begin turning your dreams into reality. I believe you'll be very glad that you attended today. By the way, we do not expect you to just take our word for it. We want you to see for yourself, and I will be sending you an invitation to attend a live trading webinar scheduled for this coming Friday. I want you to see on real-time charts the actual effectiveness of the Max trading system. As I mentioned, Eusebio is the developer of ETF, the companion, and other aspects of the Max system. He has traded Max full-time for many years, and I think that makes him the perfect choice to give us all the details about Max trading. He is a phenomenal trader. He is a skilled teacher, but here's what I like the best. I believe you will quickly come to appreciate his passion for helping traders become successful. So Eusebio, we appreciate everything that you do and for taking time to show us Max today, and I'll pass the microphone along to you.
Thank you very much for this introduction, Craig. So welcome everyone to this presentation of the MAX trading system. In fact, we call it now the MAX ETF trading system, as Craig has mentioned earlier. Before we start, I would like just to make a quick audio and video check. Do you see my screen and do you hear me well? So if you would like to type a yes or a Y in the question area of GoToWebinar, or for our MAX members in our private MAX chat room. So the MAX chat room is open for the MAX members. Oh, a lot of yes, so thank you very much to all of you. It goes too fast, I cannot see all the attendees who are answering, but thank you very much, I really appreciate. So what I'm going to show you now is some of the very important concepts of the MAX, and some of the rules we apply for our entries and for our exit. I will explain explicitly what the ETF concept is, and so the ETF indicator and its companion, the bias, directional bias indicator are, because we have two bias indicators, through some examples, and then I will make a very important announcement for the next step, the next improvement we are introducing into the MAX. So, and you will understand with one or the other example I will show. So, before starting, let me make a very quick presentation who I am. It will take just a few seconds. As you have perhaps recognized, so I'm not an English people. English is not my mother language. I am in fact a Belgian trader living in France for many years now, and I have been in the past a software engineer in the IT industry. I have worked in that career for about 28 years, and the last 15 years in the banking industry in Europe. This has given me the opportunity to be in contact with some traders in these banks, and I have learned a lot with them, even if at that moment I was not realizing what I was learning. So, and so I am also interested in trading and investment for many more years than my career, because I am in contact with the market for 35 years now, and I have experience in almost all the market. Not all of them. There are some markets I have ignored, but experience in the stock market, in the options market, the futures market, and since 2000, so 29 years now, the Forex. And since 2008, I am a full-time Forex trader, so with the MAX trading system. So this is who I am, and so now I'm going to show you what the MAX may be. In fact, the MAX has been created many years ago by late Dr. Jim Pruitt, named by his student as Tiger because of a very strong temperament. A strong temperament because Jim knew at that time he was teaching the MAX that his time was counted, and so he wanted to go fast, or as fast as possible, to share his experience and his knowledge with his students in order to give them a very powerful and reliable trading system. Or I prefer to say a trading method. Method because the MAX contains indeed not only the rules to engage, to handle and to close a trade, but also a methodology how to analyze a chart, and in fact how to analyze a situation in order to validate if a trade is a valid trade or not. Of course, as with any other serious trading system, the MAX requires to develop some skills or some keys, important keys. Work and commitment are the main important skills. It requires some work to learn the MAX concept, to learn the MAX rules, and to apply them correctly. And so this requires a commitment. Trading is not a simple elementary task. It contains some complexity, but a complexity which can be overcome if you dedicate enough time and so enough commitment. It requires also discipline, patience, persistence, concentration, confidence. That's easy to understand. Discipline and patience. I have said that the MAX is based on concept and rules. So, for example, an entry setup always represents a set of conditions to be fulfilled before considering taking the trade. And so we need to wait with patience, with discipline, that all the conditions are fulfilled. And the discipline consists in, when all these conditions are fulfilled, to take the trade and then to handle the trade based on the rules we use to handle the trade. Then persistence also. No trading system has a 100% winning rate. And This is also the case of the max trading system. We have a nice winning rate, but we still face losing trades. And the persistence consists in taking all the trades, whatever the outcome of each specific trade will be. If we have 2, 3, 4 losing trades in a row, the next one must be taken. We never try to overguess what the issue of the next trade will be, whatever the past we have experienced. And concentration, we have to pay attention to some details, even many details, if we want to optimize the trades we are handling. And confidence. Confidence is also an important aspect in trading. When we take a trade, we need to feel confident taking that trade, but for that we need to develop several levels of confidence. Confidence in the market itself, in its ability to give more opportunity that we can handle. Confidence in the trading system we use, in its ability to catch most of these opportunities, and confidence in ourselves, in our ability to apply that trading system to catch these opportunities. So this is what we focus on during our teaching, so during our learning session. Now, before explaining the rules of a system, it is important to define, in fact, what a trading method is based on. And I consider that we have, first of all, to define the type of movements we want to trade. The type of movement is rarely defined, so in many trading systems, but for me it's a key point. We have to define what are the trends we want to exploit and what are the movements inside each trend. We then have to define how such a trend or how such a movement will start and how it will start. A movement or a trend can start in different ways, completely different ways. And so these ways will be defined based on specific patterns the price can exhibit. We will call these patterns entry setups. And when we have an entry setup, this does not necessarily mean that we have a trade. We have to validate the trade or the setups under 3 types of conditions, or 4 types of conditions. In fact, we have technical conditions. In fact, the technical conditions represent the structure of the different patterns we want to exploit. Then we have the risk condition. We have to define which risk is appropriate to take for the corresponding potential trade. Then we have to check that the trade is in agreement with the global context. And then we may have other conditions. For example, when we day trade, we may have timing conditions. Also, not every moment during the day are made equal. An example of these other types of conditions and the global context is the news release. For example, we never trade through the news release. We always close any trade before an important news release, and we consider taking new trade after the news release, depending on the result of the release. And then we have to handle or to define how to handle the trade. Once we have opened the trade, how do we manage the trade in such a way to progressively reduce or at some point to cancel the risk we have on the trade. Indeed, whenever we open a trade, we have a risk. This is why, for example, we define a stop loss for that trade. The stop loss is not the only way to control the risk on the trade, but at least we have that risk because the price can indeed move against the trade and hit the stop loss. And so we have developed technique to define how to reduce progressively the risk until we get a situation as a risk-free trade. And then we can focus on how to optimize the profit we can extract from that trade. And then, of course, we will have to define how to close the trade, to close the entire trade. And so we will have 2 types of mechanisms to close a trade. We will have partial close, and then we will have to consider a total close when we observe that the movement or the trend we are trading is exhausting. And I say exhausting and not reversing, because we never know, in fact, if the price will really reverse. We can observe when the price is exhausting or the trend is exhausting, but we cannot predict for sure that that exhaustion will be followed by a trend reversal. It is possible that the trend, in fact, will resume, in which case we will have another trade in the same direction. So it doesn't matter if the trend resumes or if the trend reverses. We will have to wait for the appropriate moment. And so this is what the max will be based on. We follow that procedure to define the max, which is essentially a trend following system. It may be called a scalping system, it may be called a momentum trading system, it may be called a swing trading system, it may be called a position trading system, depending on the time frame we will use, in fact. And the max is itself an acronym based on three concepts. The M stands, in fact, for momentum. And in fact, I should say momentum and volatility. Indeed, when we have a potential trade, we need to see enough momentum and enough volatility for the trade to be worthwhile. If there is no momentum, if there is too much volatility, for example, we don't have appropriate conditions to take the trade. The A stands for acceleration. Acceleration does not mean that we need to see the price accelerating. No, the acceleration phase of the max is a technique to scaling in. Progressively, while the trend is unfolding, we will add to the position, to the trade, in order to progressively build a larger position. And this is how we will increase the profit we can extract from a movement or from a trend. Of course, doing that, we will have to control the risk we have on the position, because whenever we add to a trade, if we don't pay attention, the risk will increase. And the X stands for exit. We will have partial exit. These partial exit will be called MX, or momentum exit, and XXX, or final exit, as I will illustrate in a moment. So in the past, when the ETF concept was not included in the max, we had also ways to trade counter-trend movement and consolidation or large consolidation area. Now all these aspects of trend and counter-trend trading are generalized with the concept of the ETF. We have only the concept of trends and consolidation zone. And with the max, we have also, of course, a very strict, very solid trade risk management and very solid money management. And I like to make the distinction between both. The trade risk management consists in handling the trade. The money management consists in allocating the trading capital in order to grow an account in a safe way. So, and as I have said just a moment ago, so the max can be applied to any time frame and to any tradable market or any tradable instrument. So it can be applied to the futures market, for example, with the indices or some other commodities. It can be applied, of course, to the Forex. It can be applied to the stock market. And if it is applicable to the stock, it can be applied to the options market. So if it is important to understand what the max is, it is also important to understand what the max is not. Initially, the max was not a scalping system, but we have a lot of demand from our members to include also a scalping approach within the max. And very soon we will propose that scalping approach, which will be a very special way to scalp the market, so including the max concept, but some other additional concept based on overflow and so on. But basically, the max is not a usual scalping system. It is not a new trading system, as I have said earlier. We don't try to catch these fast spikes the price can make sometimes when we have a big surprise in a news release. These fast spikes will generate very often, if not always, very bad price execution. And we are never sure to be filled furthermore. And so we don't try to catch these movements. But after the price has calmed down, after the volatility has calmed down, then we can consider to trade in agreement with the news release. And so as you can imagine, as you can guess, the max is not an elementary buy and sell system. We don't have just one or two fixed rigid rules. We have several rules which are flexible enough to adapt to all the market conditions. So when we use a trading system, a trend following system, we may sometimes challenge some situations, some difficult situations. For example, when we have poor price action, when we have small price movement, when we have not enough momentum, not enough volatility, and so consequently when we have too tight ranges, we may sometimes miss some large movement when the price especially reverses very fast. We may have, with the max we use, in fact, some technical indicators, and you all know that the technical indicators are lagging. That's true that any indicator is lagging, but it's not necessarily a problem, in fact, because we don't try to use an indicator to predict what the price will do, but we can use indicators to analyze the relationship between the behavior of the price with the behavior of the indicator. But sometimes when the price especially reverses very, very fast, so these indicators will have a lag which will become too much important, or a lack of reactivity which will too much important, and we can miss so a nice opportunity. And most of the time, still around 70 to 75% of forex traders around the world are still using time bar charts, whatever the time frame, 5 minutes, 15 minutes, 1 hour daily. But these time bar charts, in fact, have big problems. They lack many of the details in the price movement, in the price action. So this is what we have tried to solve with the ETF concept. Just to show you a small example of what I mean by too poor price action or too small price movement, let's consider the volatility of some charts, some pairs, since the last 8 years. You all remember that 2010 represent 2 years after the subprime crisis. With the subprime crisis, we were seeing for several months a very high momentum and volatility, big movement in the market. But since then, and so during the last 8 to 9 years, we have seen progressively that the average daily range of all the pairs are decreasing to a level which is really low for the moment. But of course, this is cyclical. You can see on this chart, it's true for the euro US dollar, it's true for the pound US dollar, it's true, in fact, for all the pairs, not only the majors, but also with all the crosses like the euro kiwi or the pound yen. And so the average daily range are cyclical by nature. We are for the moment in a low level of these lengths, these ranges, but when the conditions will change in the market, and so we will see again nice average daily range. But it is these kind of challenges which led us to introduce a new concept in the max in order to still have the max profitable whatever the conditions the market will propose to the trader every day. What we will propose, in fact, today is two courses, so the Max ETF Primer and the Max ETF Standard. We have other level of the course, the Max ETF Advanced and the Max ETF Sum, but these are for the moment outside the scope of this presentation. I will focus on the Primer and the Standard. And with the ETF concept, as I will show in some example, the ETF concept will allow to trade many more movement than the past max, the classic earlier max, to trade consequently also larger movements, simply because we recombine into a unique trend, a movement which is contained of a traditional counter-trend movement and a traditional trend movement, and we can be more nimble in the way to handle these movements. And let me show some example just to be clear. I will use these terms in terms of glossary in the example I'm going to show. MO represents an entry setup. MO is the abbreviation for momentum entry. XXX is a complete exit. MX is a scaling out or a partial exit or a momentum exit. SC represents a scaling in or adding to a trade. R will represent the risk, and RRR will represent the reward to risk ratio, the result of the trade in a normalized way using Von Tarp notation. So let me show you a first example, which was an example of a few days ago with the Max ETF Primer. In this chart, you see the price, of course, and some lines we have a long-term moving average we call the home base, which is an important moving average used by many professional traders. It is a 200 moving average. There is no secret about that moving average. We don't use 200, we choose a number which is close to 200. We have a shorter term moving average, which is the gold line. It is called the momentum line. And then we have the ETF lines. The ETF lines are these two lines in yellow and orange. They are based on a complex formula in order to have these lines extremely regular when the price is nicely trending downward or upward. It is not very sensitive to the pullbacks the price can make. Of course, when the pullbacks is more important, these two ETF lines will be sensitive to these pullbacks, but they are extremely regular, and we see clearly when they reverse. And they reverse, they have a very small lag. They reverse very close to the price reversal itself. The lag is between 1, 2, and 4, 5 bars maximum, never more than 5 bars, or exceptionally 6 or 7 bars, but very, very exceptionally. But these ETF lines are not enough, of course, to define a trend. No, Bill, it's not complicated. It's really simple. When you know the concept behind these tools and the way to use them, it will become really simple, in fact. And then we have a companion indicator, which is called a bias indicator, to tell us when a trend will start and when a trend will possibly reverse. And the companion indicator is here located at the bottom of the chart. It is made of two lines, one green and red line and one blue-orange line. The blue-orange line represents the short-term bias. It is called the fast bias. And the green and red line is called the slow bias or long-term bias. And in fact, the trend is really simple to define. When we see a green slow bias, we have an uptrend. When we see a red slow bias, we have a downtrend, technical trend. And so when the trend is upward, we will look only for long trades. And when the trend is downward, we will look only for short trades. And then we apply the rules to handle the trade. On a technical point of view, so here we have an example of an entry setup. An entry setup is a specific pattern the price is exhibiting, and it has a name. It happened that in this example, the name is an ETF S&P MO, which means a safe and perfect MO. It is called safe and perfect MO because it is one of the most reliable entry setup we have. It is even the most reliable entry setup we have. But it is not the only possible entry setup we have at the beginning of a new trend. We have, in fact, 3 possible setups depending what the price is doing. We have a safe and perfect MO, we have a breakout MO, and we have a breakthrough MO. After that entry, we have rules to define our stop loss, and the stop loss is called an ESL, an emergency stop loss. The aim of this stop loss is not necessarily to protect the trade, but to protect the trading account. Indeed, we never know for sure for each specific trade if this trade will be a winning trade or a losing trade. And even if we have a good guess for the trade, it may happen that we become blind for the trade. For example, we may have a problem with our internet connection. We may have a problem with our PC. And if at that moment the price reverses and goes against the trade, if we don't have a stop loss, we may have a huge loss. And so this stop loss, this is why it is called an emergency stop loss. It is a hard stop loss. It's there to protect the trading account. And it is on this emergency stop loss that we define the risk associated with the trade. It may be 1%, 2%, whatever you want, based on the trading account size. Later on, when the price moves in favor of the trade, we will have rules to make exit. And it happens in this example that this MX number 1, it is a momentum exit number 1, was respecting an exit rule. We have around 20 different exit rules to handle all the exit of the trade. So when we have opened the trade, we consider the trade is made of 2 units. When we make a momentum exit, we will close 1 unit and we will keep the second unit as a running unit in order to try to capture the largest possible portion of the trend. Later on, we may have another exit setup triggering, and here we were left with 1 open unit, so we close that second unit. Now, when we trade with the Max ETF Primer, which is the simplest version of the Max, to make the final exit, we have in fact 2 choices. Either we close the second unit, oh sorry, I went a little too fast. We close the second unit as soon as we have a next exit setup, or we can wait for the trend reversal. I have chosen here to close the trade immediately after the next exit setup in such a way that if the trend resumes, we are still in an uptrend, we can take another trade with a setup which is called a breakout remo in this case. The name is associated to the pattern the price is making. We associate, of course, another stop loss. The trade is considered as made of 2 units, and then whenever we will have an exit setup, we will close 1 unit and then the second unit. And so you can see that in this example, we had 1 entry, 1 scale out, final exit, then another trade, another entry, 1 scale out, and then the final exit. When we consider the result of this trade, the first trade has made a total of 47 pips. Because the stop loss was 25 pips, the reward to risk ratio is plus 0.94. When we say 47 pips, this is the number of pips made by the 2 units. So we add the 2 number of pips made by each unit, but then we have to average that number to have the real result of the trade. This is why we have to divide, first of all, 47 by 2, and then the result by 25 to give the reward to risk ratio. And on the second trade, because the movement was larger, we get a larger reward to risk ratio, 2.21 in this case. R representing the risk. It may be 0.5%, 1%, 2% of your trading account. It depends on each trader. The 2 trades at that moment have made a total of 3.15 R. If you trade with a risk of 2%, this represents a 6.3% profit. Of course, this is a partial way to explain the trade. In the course, we explain in fine detail. We give all the details in the way to handle that trade. For example, how we adjust the stop loss. Now, this is an example of a movement a few days ago with the Max ETF Primer. The Max ETF Primer is a subset, a very small subset of the Max ETF Standard, and the Max ETF Standard has a very, very powerful concept, which is the scaling technique. Now I'm going to show you the same movement with the scaling technique. And here we have the same entry. No, sorry, it is not the same entry, because with the Max ETF Primer, Max ETF Standard, we have more entry setups, and we had the possibility here to make an entry earlier compared to the Max ETF Primer. So we make the entry. Later on, we have that entry as illustrated in the Max ETF Primer, and it will be considered as a scaling. A scaling consists in adding 2 additional units. So we add 2 units having the same size as the initial trade. And these 2 units will have the same stop loss as our initial trade. So at that moment, when we have made the scaling, we have 4 open units. When we make the MX, we close 1 unit. We are left with 3 open units. Then we have another scaling opportunity immediately followed after that by an MX. At that point, we have 4 open units because we had open 3 times 2 units and we have closed 2 units. Then we have a scaling number 3, an MX number 3, an MX number 4, and then our final X66. We were left at that moment with 4 open units, and so we close these 4 open units. And we close the unit using the FIFO rule just to comply with rules applied in USA, in Canada, in the way to close the trade. So the FIFO rule. So the first unit which is closed will be always the oldest open unit. Now with that scaling technique, and provided we control the risk with an appropriate scaling out and stop loss adjustment, the result is completely different. Now we have got a total number of 522 pips. representing with the same stop loss, or perhaps a stop loss different from the previous example, a total reward to risk ratio of 10.04 R. We can compare these 10.04 R with the result of the max primer, which was 3.71. So with the max standard and the scaling technique, we produce a result which is 3 times larger, in fact. So this was an example of a long trade, a recent long trade. Another example was on the pound kiwi. Sorry, I have to move on the next page. It was the same example. So I think my second example has disappeared from my PDF, but that's not a problem. So, or I'm moving my slide, my PDF in the wrong order. Sorry for that. I'm using the arrows on my keyboard, so I was mixing the keys. So this is another example, a short trade now with the pound Aussie. And similarly, with the Max ETF Primer, we have been able to make 2 trades. You have the kind of result here with a total reward to risk ratio of 3.71. And the same movement with the scaling technique get one unique trade with several scale, 2 scale-ins, in fact, several scale out, producing a result which is, in this case, almost 2 times larger than the Max ETF Primer. On this chart, on this example, you see one additional ETF stand, Erica, for extended trading format, as Craig has explained. So in his introduction. So Jerry, if the voice is very bad, I don't understand really your comment. Perhaps my accent is not good, or perhaps the audio is not good, and this should be normally on your side. Sometimes this happens. Yeah, the audio. Okay, so it must be on your side. So try perhaps to close some other software you are perhaps running. This sometimes happens due to some problems on internet. So, but anyway, the presentation is recorded. You will have the recorded video at your disposal in a few hours. So on this chart, I'm showing another feature we have with the Max. You see that horizontal line. Depending on the pairs, we may have one or several horizontal lines on the chart in different colors, white, red, purple, magenta, and so on. And these horizontal lines represent possible supply and demand level. And when we have these supply and demand level on the chart, they may represent, for example, support and resistance. I prefer to talk about, because it is the way they are defined, I prefer to talk about supply and demand because they are linked to the liquidities, the potential liquidities which are in the market. And so when we see that the price is going towards such an horizontal line, we have to consider seriously to make an exit. And you can see how the final exit is made precisely in the area of that horizontal line. So, and it was quite a perfect exit level for our trade. And of course, when we consider to open a trade, if we have a level, such a level which we call a max price level, we need to be on the right side or far enough from these levels. There is something else you see also on this chart. You see that this down movement, and so short trade, because the slow bias was red, was downward, is followed by a green slow bias. So this means we have an uptrend following the downtrend. And the question is, will we take this the corresponding long trade or not? If we trade in a very mechanical way with the max, all the trade must be taken. But it is not what we advise to do. I have said previously that one important condition we have for the trades is to be in agreement with the global context. The global context, in fact, contains several important aspects. All the geopolitical events which may impact the market. For example, there is one well-known example for the moment, which is the Brexit. So the Brexit has an important impact, day after day on the pound pairs. We have the situations in Middle East with some countries like South Arabia, with Syria, with Iran, and so on. And so these situations may impact some market and may impact the fact. So we have to take into account these geopolitical events, and there are a lot of such events we have to consider. We have to consider also the decision made by the central bank, not only on the interest rates, not only on their monetary policy, but also on their daily operation, because the central banks may make intervention on a daily basis in the market, and these daily operations will have an impact in the market. So, and then we have to pay attention to the news release. Of course, the news release with some important microeconomic or fundamental factor will drive the market, depending if we have an important change in these factors and a big surprise, a surprise which is not expected. For example, when we have a very big, strong number on the non-farm payroll and a corresponding good number in the unemployment rate, we have a positive movement for the US dollar. So we have to take this into account. And so that global context will tell us in which direction we have to trade. If the context tells us for the pound Aussie that we have to trade the pound Aussie short, then we will ignore the long trades as long as the context has not changed. Okay? If the context changed at some point to the long side, then we can consider to take the long trade and we will ignore the short trades. And because the context analysis is a task which is not so simple to consider, not because it is a complex task, but because it requires sometimes, and not everyone has the possibility to make that analysis because of time constraint. Those who have another normal job don't have necessarily the time to look for all the information which is necessary to consider, to define the context. And so we are going to launch in November, the beginning of November, a new service which is called the Max Bias Advantage, where we provide in time condition, in real-time condition during the day. In fact, during the European session, we will provide to our members, to the Max members, and Max students, these contexts for a certain number of instruments, some major pairs, some pairs we recommend every day, some important indices like the S&P 500, the Dow Jones, the Nasdaq, the DAX, and so on, and two commodities, gold and crude oil, in such a way to have a panel large enough of instrument for every member in the Max community. And we intend in the very near future, in a few weeks perhaps, to also open this service to anyone who is interested to have that context definition. And with that context, in fact, we will avoid to take trades against the context, and we should see, in fact, a winning rate between 80 and 90%. In fact, all the tests I have made up to now, all the experiences I have made up to now, because I'm working on that for some time now, I see a correct context definition, and so correct trade direction in more than 80% of the case, sometimes 90% of the case. And so this is something the Max members and the other non-Max trader will have the possibility to exploit. So, of course, in the two examples I have shown, so we have seen example in the 5-minute time frame, but in fact the Max can be used in any time frame. I will not go through additional example. You have understood the concept, the idea, but it can be used on any time frame and on any instrument. This example in particular shows the oil, the crude oil, with the 30-minute time frame, and we have an example of a long trade which has exactly the same structure: one entry, two exit with the Max ETF primer, and one entry, several scale-ins, several momentum exit, and one final exit if we use the Max ETF standard containing so the scaling technique. And you can see the difference in the reward to risk ratio. By the way, we never use when we open a trade, a fixed target profit. We don't try to catch a 1 hour or a 2 hours or a 3 hours. When I say 3 hours, this is equivalent to say a 3-to-1 reward to risk ratio. Because in fact, when we want to trade a trend, the idea is to catch a portion as large as possible of that trend. If the trend provides 10 hours, we would like to catch these 10 hours. If the trend provides only 1 hour, we want to have that 1 hour. But let's say, for example, we fix a target profit of 2 hours. If the trend provides a 10-hour trade, we will be frustrated because we have missed a large portion of the trend. If we choose a target profit of 2 hours and the trend gives only a 1 hour and then reverses, we have a losing trade. So using a fixed target profit is not for us ideal to trade trends. So we prefer to, as Jim was used to say, to milk the trend at best. So this is why we don't have the same result for each trade. The max can be also used, of course, with a higher time frame, even higher time frame. This is an example of a daily time frame, and this time with the Dow Jones Industrial Average, so the Dow Jones 30 index. So on a period of several weeks or several months, to trade on a period of around 3 months approximately. And you can see that with the Max ETF Primer, we have exactly the same structure of the trades. The chart is not the same. An index, a stock index like the Dow Jones or the S&P 500 or a stock simply does not behave as a currency pair in the Forex. The chart looks similar, so they can be traded in a similar way, but the reason and the mechanism to create that movement in the market are completely different. Okay, but the trades have exactly the same structure. And with the Max ETF standard, so we have exactly the same mechanism with the scaling technique, which improves, in fact, the result of the trade. You can see here, 6 hours with the Max ETF Primer with just 2 trades, 19, almost 20 hours with the Max ETF standard with just 1 trade, but several scale in, several scale out. So US dollar in the daily time frame. So we can use any instrument with any time frame. I have said that we don't have a 100% winning rate. If we don't use the global context, we have with the max 70 to 75% winning rate. If we use the context, if we trade in agreement with the context, global context, then the winning rate explodes to 80 to 90%. But when we still have a losing trade, the guarantee we have with the max is the loss will be always a small loss, simply by the fact that we have several exit techniques, and the exit techniques also applies when the price is moving against the trade. This is a typical example when we open a trade on a valid setup, and then for a moment the price moves in our favor. At some point we have an opportunity to close 1 unit making 1 MX, and then suddenly the price reverses. And in fact, almost always one of our exit technique will trigger before the price has a chance to reach our emergency stop loss, which contributes so to reduce the loss on the trade. You see in this example that the loss is only minus 0.11 R, so 1/10 of 1 R, so 1/10 of our initial risk, simply due to that double step mechanism for our exit. And in general, a losing trade on average would be around minus 0.5 R. Often less, sometimes a bit higher, but on average 1/2 R. So not 1 R, because we don't allow the stop loss to be touched by the price. This will sometimes happen when the price moves very fast. So, and there is a specific concept we use within the max. If we have several entry setups, this means that we have to take also in consideration the conditions under which the price is moving. And we define the way the price is moving through the idea of the price modes. The price modes represent a specific market conditions, and we have 5 of them. We have the trend mode, we have the counter trend mode, we have the consolidation zone mode, we have the choppy mode, and we have a special one which is called the spaghetti zone. And each of these price modes represent a specific way for the price to move. Some of them are self-explaining by their name, trend mode, for example, or counter trend mode, that pretty much easy to understand. Let me illustrate an example of such a price mode, which is the most difficult mode to recognize, which is the choppy mode, or the choppy market. So the choppy market is in fact defined when the price is moving in a complete erratic way in a rather large range. In the course, we explained in great details all the conditions, all the tips we can use in order to recognize a choppy mode as soon as possible. It requires some time to recognize a choppy market. For example, it may require 20, 30, 50 bars. But once we recognize at this point, for example, that we are in a choppy mode, we can make the assumption, which will be a strong assumption, that this choppy mode will last many more bars, usually 100 to 200 bars. And the implication of that is, when we are in a choppy mode, it's better very often to ignore any trades. However, if someone decides to take the trade in a choppy mode, we have a very special way to handle such a trade in order to optimize the result, which will be often a small result we can catch on such a choppy mode. And sometimes it will be a loss, because the choppy mode is really challenging to trade. And so it will be up to the trader to decide to skip a trade or to take the trade, but to handle that trade in a very specific way. So this is for the choppy mode, and the spaghetti zone will be a special nuance of the choppy mode when we have a very, very tiny range. In fact, these price modes can be explained in a very simple way on a technical point of view, combining momentum and volatility, and we do that so in the course in great detail. So now we apply also, I have illustrated through this example some aspect of our trade risk management, but we also apply money management. And the money management consists in, first of all, choosing a rather small risk per trade. It is often said that the maximum risk we have to take per trade is 2%, but personally, and this is just my personal opinion because I am a very risk-averse trader, but I consider that 2% is even too high. It's better for me to take a lower risk, for example, maximum 1% or even less. We can, in fact, have exactly the same approach as many important hedge funds. The hedge fund consider a very small risk per trade, 1/10 of 1%, and even sometimes less, depending on the market conditions. Of course, their profitability will be smaller also in consequence, because if we take larger risk in our trade, we will get better result on a long-term perspective. So, but do not consider that we need to take large risk to make nice profit. This is not always true. But what is important is not necessarily to make big profit, but to be consistent in the way to apply the trading process. The trading process consists in defining through the concept and the rules we have at our disposal a trading plan, and to follow the trading plan. So the process must be applied in a consistent way. And when we do that with patience and discipline, the result follows. Of course, we may have some losing trade. For example, do you realize that even if we have a 70 or an 80% winning rate, we will still face losing streaks made of 4 to 10 losing trades in a row. This is not uncommon. 4 to 10 losing trades in a row when we have a 70 or 80% winning trade. And so the money management consists in surviving these losing streaks. And this is why taking a small risk per trade is very important to reduce the drawdown these losing streaks may cause. And the situation may sometimes be not often, but it may sometimes happen. We may have clusters of losing trades. And so this is why controlling the drawdown is extremely important, and the money management contributes to control the drawdown. And then the compounding approach will allow for the account to grow in a progressive way and sometimes to accelerate. When we have normal market conditions or good market conditions, an account can grow very quickly, even with small profits per trade. Let me just show you a small portion of an example of our money management. So we have three portions. I'm not totally satisfied with this slide, but at least it helps to show some concept. If we consider a 2% risk per trade, for example, and we consider a 2R reward to risk ratio, indeed, if we consider an average stop loss of 15 pips and a number of pips of 60 pips, remember each trade is made of 2 units, so we have to divide these 60 pips by 2. This gives 30, and when we divide 30 by 15, we get a reward to risk ratio of 2R, or 2 to 1. And you can see that through the different trading period, they can be trading days. If we are able to generate such an average profit per day, for example, an average profit, this means that some days we will have more profit, some days we will have less profit, some days we will have losing days. But if we are able to get that average result per day, you can see how the account can grow very quickly. Even after 1 month, the account may double. And with more months, the account can grow very quickly. Now, 2 hours is a good result. But even if you consider only a 1 hour result per day or even a half hour result per day, your account will grow very quickly. For example, if your reward to risk ratio is expressed in terms of percentages of your trading account. If you are able to make on average 0.5% profit per day, whatever the number of trades you may have 10 trades, but in total you have a small 0.5% profit. If you are able to do that every day, at the end of the year, you multiply your account by 3 with the compounding process. Now, I don't say it is easy to trade every day. Of course, it may be a challenge to trade every day, especially if you have another job. A full-time trader can trade every day. But to be frank, myself, I don't trade every day. I trade between 2 and 4 days per week, because there are some days I consider it's better not to trade. Okay? Depending on what is happening around the world, depending on the news release. It's clear that when we have an important interest rate announcement by the Fed, when we expect important numbers with the non-farm payroll, usually the 12 or 24 hours preceding these news release, most of the time the market will be extremely quiet. Better not to trade. And so this is why this example is just an extreme example, but at least it has the merit to show what is possible. It gives you an idea of what is possible if you get consistency in applying the system. So now the courses are organized into 5 levels: the Max ETF Primer, the Max ETF Lite, the Standard, the SAM, and the Advanced. We propose to you today the Primer and the Standard. The Standard is our flagship course, which contains all the important concepts, especially the scaling technique and a very solid trade risk management and money management. The Max Primer is just a small subset of the Max Standard, just to give you an idea what the Max may be, if the Max may be convenient for you, if we are legit to teach such a trading system, and so on. So just the first way to approach the Max concept. Chris will be a little more detailed in that approach. And so with the Max, in fact, you have a very solid, sound methodology. We explain why this concept works in relationship with what the big boys are doing. So who are the big boys? The big boys are the big traders in the important bank or in big hedge fund. So those actors in the trading community who are able to move the market. But not only the traders, but also some other actors who are not necessarily traders. Because perhaps you know, perhaps you don't know, but around 80% of all the transactions in the Forex are not speculative trades, but they are commercial, corporate trades, for example. But these are also important to explain why the market is sometimes moving in a very specific direction and explain the amplitude of the movement. And the trading, in fact, reinforces these important aspects. So we trade the price action. It's true that we use indicators, but these indicators are only tools or a guide to go faster, to pinpoint interesting situations on our chart. So to observe a potential trade, But I say a potential trade, we need to go deeper into the analysis of the chart, or potential exit. And then, so as I have said, a very solid trade risk management and money management. And we always focus, you have perhaps understood that, we focus essentially on the trade risk management. We are not interested in following the profits we can make when we are engaged into a trade, but what are all the ways to progressively reduce the risk until we get a risk-free trade or a guaranteed profitable trade. If you control the risk, the profits will follow. Through these courses, we pay a lot of attention to the personal confidence development through our coaching or mentorship approach. The homework are an essential part of our training, because they provide, as Chris will explain, a lot of feedbacks. The practice, we have practice sessions in terms of follow-up support. Once you have taken the course, you are not left alone. There are other activities you are advised and invited to follow. We have some workshops, we have a forum, and we have these practice sessions each Saturday. And so this is what the max is and what I wanted to present to you. If you have any questions, so feel free to post them in the question area of GoToWebinar. And now I'm pleased to give the mic to Chris to explain the other aspect of the max. So Chris, it's up to you.
Thank you, Eusebio. Hi, everybody. I'm Chris. I'm based in New Zealand, and I'm partnered with Craig and Eusebio in the max trading system. Just to give you a bit of background, this is our 66th set of max courses, and as you can gather, we've been running since about 2008, and have got over 2,000 members. So been at this a while. Next slide, please, Eusebio. And hi to all the maxes. Thanks. So one of the really important things about the max, I think that distinguishes it from most other courses, is that we have homework. We assign homework after each session. It's up to you if you want to do it or not. But what we do is Eusebio goes through the session. He's the trainer most times, and then we will ask you to mark up some charts. We'll show you an example on the next slide what they look like. But it's to make sure that you actually understand what's being taught. Sometimes, and I do this quite often, I will think that I understand something, but it's only when somebody else looks at it and says, no, you've got that upside down. It's happened a few times exactly like that. So by having somebody else check what you're doing, can verify what you're doing and point out little tweaks or adjustments that you can make to make it even more powerful. So we want you to verify you understand things correctly. It also makes you an active participant rather than listening to a video or reading a PDF that just sits in the ether. It actually crystallizes your training. It makes it tangible. You get your hands dirty. And during the homework, I generally grade it. I provide extra suggestions, point out little bits and pieces that may not have been included in the course. And you also get to see everybody else's homework as well. A bit scary, but everybody only cares about their own homework, so don't worry about that. But you get to see what other people are doing and other opportunities. So the multiple charts actually speed your learning up. So we want to give you as many different hits of how the max works and examples as possible. And the session isn't able to do all that. And generally students find all sorts of stuff that they get into trouble with, and it's a really good way of being able to see how to handle different situations. So next chart, please, Eusebio. And you get to ask whatever questions you like as well. If I can't handle them, then I ask Eusebio to sit in. And sometimes if the chart is quite nasty one, then we'll bring it up during the training session itself and go through it. So here's an example of the homework. On the left-hand side is what a student might have sent in. This one's called a breakout remo. We'll explain all that terminology later, with the stop loss placed and all that sort of stuff. And then the instructor's replies. So these are a couple of example replies to show you how fulsome they are. And I think that's the right use of that word. How many words there are in it. And Yeah, they get quite detailed. So when I do the replies, I go down to bar by bar level and pretty much analyze each bar and explain what's going on with it. Okay, next slide, please, Eusebio. So the homework is quite detailed and thorough. Okay, so and I'm not going to take long here with this because I know a lot of you are waiting for the giveaway, but here's a comparison of our different courses. We've only got 2 that are on offer today. That's the ETF Standard and the Primer. There is also a third one, Light, which I'll explain a bit about. But the difference between these is the Standard one is our flagship course. This is the one that's got the profit acceleration in it, where you can get 30 to 300% increase over just a simple buy and hold system. And the Primer is basically a simple buy and hold system. So with the Standard, you run with 7 sessions as opposed to 2 for the Primer. You have over 8 different entries with the Standard as opposed to about 2 for the Primer. And with the Standard, there's a huge list of exits. If you're trying to scale in and want to make as much money out of a trend as possible, then you need as many details and information on how to limit your risk as possible. It's not difficult, it's just quite automatic as you're moving through the chart. But we have a lot of different exit points that can be used, and once you learn one of them, it's translatable to all sorts of different situations. So once you learn one thing, it's you don't have to sort of keep relearning a lot of them. Okay, so the Standard has got the profit acceleration, whereas Primer does not. It's just, like I said, a simple buy and hold. And the difference between them is the profit acceleration gives you, as I've been saying, a 30% to 300% and more increase over what the Primer can actually pull out. And the Primer would be basically what you're trying for now. And the Standard comes with the money. All the courses come with money management, but the Standard comes with an enhanced money management to take care of all the scale-ins and the pyramiding. The ETF Primer is got a simple money management system, but it's very safe. With both of these, if you get into a trade and it turns bad on you straight away, and you have a string of these, then on average you will only lose half of what you risk. So if you're betting, say, we'll go through how to do order placement and position sizing in the courses, but for instance, if you're betting $100 on a trade, then the most on average that you would lose is $50, so long as you follow our rules. And on average, the returns are much, much better than that. With the Standard just blows away most other profit-making courses. The ETF Lite kind of sits in between the two. It's Primer on steroids. It's got an extra entry, a couple of extra exits, and you'll see how it fits in with the scheme of things. But what you need to do, if you want to do Lite, you have to take Primer. If you want to do Standard, you can jump straight in and take it, and we recommend that you do that. If you're a regular trader, if you're trading now, then the Standard can boost your existing profits for any trend entries that you do. The Primer that we have is there to give you a taste of what we're like, just so that you can see that we're not messing around here. But if you really want to maximize your return on your investment, then the Standard is the one to go for. For those of you who are really starting out super basic, then what I recommend is doing the Primer first, and then the Lite, and then the Standard, and that will give you 4 months worth of training. You really get immersed in things. With the Primer, I've also found, because I've done the training as well as the homeworks myself, I've trained people in Standard and in Primer. I found that people that take the Primer course, it's harder for them to pick up on things because they're not immersed in the course. The Standard, you're there for 7 weeks. With the Primer, you're there for 2 weeks. You can keep sending the charts in and we'll keep trying to help you, but there's just not the total immersion that you get from the Standard, where every week you're shown the trades over and over again. Okay, once the course is finished, down the bottom, during the course, every course session is videos are made. In fact, they're made all over the world just in case something breaks down. So you'll get the video of the session straight afterwards so you can review it. Every course has got its homework, so if you want to do them, they're there. And yep, okay. And once the course is finished, there's several things that we do afterwards as well. There are practice sessions. We call them scrolling parties. There's no charge for them, and as Eusebio's been saying, they happen pretty much every week, except this week because we're doing the promotion. People with the standard get the most number of them. Primers get them every now and then because every now and then we have a standard course scrolling party, and so that bumps the primers out. Sorry. There's also a Max forum that you can sign up to, and in there we have some indicators for some other platforms and other information that you might want to talk or discuss about or show your charts off. And you can ask us questions at any time. We have regularly people sending their charts in to find out, hey, this didn't work out for me. What did I do wrong? Did I do anything wrong? And these days, it's with the Brexit, it's been pretty jumpy if you're trading the pound pairs. Once you've done the standard course, then you can take any of our advanced courses. So we have 2 extra advanced courses at the moment, the ETF SAM and the ETF Advanced. SAM gives you finer entries and, more entries and finer price precision, and is more profitable than just the plain old standard. And ETF Advanced boosts it again with more entries and money management, correlation, market forces, all that sort of stuff tied into it. So each one of these courses builds on the other one, and it doesn't really matter which order you take them in. Next slide, please, Eusebio. So to sum this up, our courses are very detailed and precise. So we'll show you how to find a setup, whether it's an entry or an exit, and then show you how to execute it within 1 to 4 pips if you're using a 5-minute chart, even down to half a pip if you're using some of the slower moving ones, say through an Asian session. So they're very detailed and quite precise. We use, when we're training the MetaTrader platform, if you don't know about it, we've got help videos which will take you through it. I can help set you up. It's pretty simple. There's no fees for it. The data feed is free. We ask everybody to use a particular broker just so that everybody's charts look the same. You might think that 5-minute charts don't vary, but even between different servers on the same broker, they can vary. So we get everybody looking at exactly the same charts. And we supply all the indicators and templates for you. So you just put them into the folders and then put a template on a chart, and there you are. You're all set up. So as I said, we provide all the course materials, the videos, the PDF, any notes, examples, the chat transcript afterwards. And of course you get the homework. This is where the information goes from being just a fluffy idea into being reality for you. So next slide, please, Eusebio. Okay. As I was saying, after the course is finished, you get lots of invitations afterwards. You're invited to the forum. There's no charge for that. You're invited to the practice sessions most weekends. And we also, you'll be put on the news watch list. You don't need to be invited. You can jump on it already. And this will tell you particular times through the day to avoid. I think Eusebio will show this a bit later on in the session. But it takes some time to prepare each week. It's freely available on our website. And because news events that come out can cause spikes or strangeness, we, meaning Eusebio, goes through and lists all the possible items that are going to cause problems for you. So we know when the news is coming out and when it could cause a problem, so we know how to mitigate that. We also give in the Newswatch list a selection of the top pairs to be trading as well. So a lot of the times, if you're just trading the majors, you've got 28 different pairs there. Which one should I be watching? So Eusebio goes through the list. I pull the list out and get the best movers for the past 4 weeks, and then Eusebio goes through even further and matches them up with the news for that particular day so that you know which pairs are likely to be the best movers for that particular day. And so that instead of having 28 to look at, can whittle it down to, say, 3 to maybe 5 pairs. Takes a lot of the pressure off your trading. What we want so that you have the result that you get is a good solid trading method, and we will give you as much support as you ask for. We know that trading's not easy, but with the standard you'll have one of the most powerful trading methods available, especially when you can jump onto a trend and milk it. And hopefully you get to achieve your goals, becoming debt-free, retirement, independence, looking after your family, philanthropy, whatever it is that you're after from trading, getting out of a job. This can help you. Next slide, please, Eusebio. So what's it going to cost? And here's the standard tuition. This is our flagship with all the entries and the precision and the tighter stops and the profit acceleration. It runs for 7 weeks on Thursdays and at 3 p.m. New York time. And if you can't make it for the actual times, no problems, because we send the videos out. And about I think about 30 to 40% of our students are taking the course by video instead of actually live. So there's no problems with that. The regular price is $3,000. It's a one-off hit, and you get everything included in it. There's nothing else that's needed to be purchased, although we do have a few extra bits and pieces if you want them, but they're not required. The webinar special that we have is for $2,399, and Craig can sort out payment plans for you if you want to drip feed it out over an amount of time. And the full training package for all 3 courses, this is the primer, the light, and the standard, so that's 4 months worth of training, is $2,679. So it's only a $300 bump up, and you get all 3 courses. The primer and the light course are subsets of the standard. So if you take the standard course, you automatically get the information that's in the primer and the light. Next slide, please, Eusebio. And so the primer, which is just there to give you a taste of what we're like if you need that sort of reassurance. But we've been running 10 years. Yep. And if you want to check us out on Forex Peace Army, you should find some nice comments from students. The primer course, only 2 sessions. Like I said, it's you're left more on your own because you don't have this full 7 weeks worth of training. It's profitable. It's a good, safe start, but it's not that special, not like the standard is. It runs for 2 sessions, November 18th and the 25th, so it's about a week in between, I think. And the normal price for it is $329, and we've got a webinar special, as usual, of $159. And if you just wanted to do the primer and the light package, 2 courses, it's $759. Over to you, Eusebio.
Okay. In terms of the news watch list Chris has mentioned, so on our website, the website address is www.maxtradingsystem.com/newswatch. Perhaps Chris will put the link in the chat area of GoToWebinar. And so every week we update this page, which is made of several parts. First of all the geopolitical elements, or some of them, we have to pay attention. For example, the situation in Italy is a situation we have to pay attention. We may have bad things coming from Italy. We have the situation between USA and Iran, for example. We have the non-ending Brexit process. This has a huge influence on the pound behavior. So we have a lot of points we have to consider every day and to define what may be the influence when something happens. So after that, we have a mini economical calendar. When I say mini calendar, this means that we consider only the news release in the calendar which have really an importance in the Forex. Not all the news release you have in traditional economical calendar will have an influence. Many of them have no influence at all. And we consider, you see here on one page, we have almost all the news of the week. It was the last week, the week which has ended yesterday. And they are labeled major. A major news release is always an important news release. Sometimes we have a news labeled as monitor. A monitor news is simply a news we can follow and we can expect just some additional volatility in the market, but not necessarily big movement. Now with the major news, we will have an important movement if the deviation with the news release will be important. And so we make the distinction, of course, also with an impact in a small time frame or in a higher time frame. When you have a major label followed with no time frame, this means that the impact will be only present or should be only present in small time frames, from the 5-minute time frame up to the 1-hour time frame. If we indicate H4+, this means that the impact will be also in the higher time frames, 4 hours daily. And TBD means to be defined because there was no forecast in the traditional economical calendar. Below the calendar, you will have also what Chris has mentioned, the top 10 list. This gives, based on a statistical analysis of a recent past, what are the pairs which are the most moving. Because remember, we are trend following traders, and we want to catch the best trends. And the best trends are made with the pair which move the most. And so we define every week what are the pair which will have the highest potential to move the most. And then when we match that top 10 list pair with the news release, we get a suggestion for each day of the week, and for each day of the week we have a subset list of pairs. For example, last Monday, the pairs we were suggesting to follow, to monitor and to trade possibly, were the pound yen, the euro yen, and the pound Swiss, depending on the news release, and so on for each day of the week. And below this suggested pair, we have so an explanation how to interpret in details, so the news, the calendar, so the calendar as we provide it. So this is an information you can access for free every week. On the home page here, in fact, on the home page, if you go on the home page, you can subscribe to our information. You can introduce your email address, your name, and so whenever the news watch list will be updated, so usually every Saturday, you will be informed automatically. But you can check regularly when the page will be updated. So usually, as I have said, it is on the Saturday. Sometimes it may be on the Sunday, depending on our own activities. So this is the first one, which is a free information we provide, and which is extremely useful. So a second type of information we will start to provide. So in a few days now, starting at the beginning of November, first of all...
Sorry, Eusebio.
Yes, Chris, please.
The price levels are free as well.
Yes, indeed. We have the price level, indeed, which is indicated here on the next page. We have the price level, the news watch list. So, and so an information which is not. Oh yeah, for the price levels, we have two types, in fact, of subscriptions. We have a free one and a paid one. For the free one, I provide the price levels for just 4 pairs: the Euro US dollar, the Euro Aussie, the pound yen, and the Aussie yen. There is a paid package. The fee is, I think, $49 or $59 per month. I think it's $49 per month. Contains approximately 30 instruments. So all the pairs in our top 10 list, all the majors, plus some indices, the S&P 500, the Dow Jones, the Nasdaq, the FTSE 100, and the DAX, plus also oil, crude oil, gold, and, because this has been requested, the Bitcoin. I don't advise to trade the Bitcoin, but it has been asked, so I provide also the max price levels for the Bitcoin. And so this package represents 30 to 32 instruments, so with a paid subscription. And then coming very soon in real-time conditions, so the pair direction service, so the max bias advantage, so which will be represented as follow. it will be available through a shared sheet, a Google Sheet, in fact, and it will have the following structure. Every day, when I will sit in front of my screen, whether I trade or not myself, so I will indicate for the 7 major pairs, so all the pairs containing the US dollar, plus for the moment the euro pound because of the Brexit, plus the pairs we recommend for the day, plus the indices. So here, and then I see that there is something which is missing. Normally we should have also the pound and the gold and the crude oil. And I will provide in real-time conditions with a timestamp system the direction we have to consider the trade, which is based on my analysis of the context. For example, when we say here the euro pound at 11:01 my time, but we can change the time zone. I will provide the time with the US time zone, the New York time zone. We have here a change in the bias going from upward to downward. And so starting from that time, we had to trade short the euro pound. And then 4 hours later, the context has changed, and now the context to trade will be upward. So we will have to consider only the long trade. And we can see in this example that almost 2 hours later, the context has still changed, so to the downward. So up green arrow represent an upward bias, red down arrow represent a downward bias. Now we have 1, 2, or 3 arrows depending on the importance of the bias. A 3 arrow represent a strong context. A 1 arrow represent a weak context, so riskier trades, and a 2 arrow represent an average context. So there are trades we can take with, for example, a medium, an average risk. And sometimes the context will be followed by 2 asterisks. When I begin to scan the market to analyze the market for each pair, so it's possible, let's say for example the Aussie US dollar, it's possible that when London opened, the context was already in a specific direction for several hours. And so a 2 asterisk indicate that the context has started possibly several hours before, and we are still in the same context. Unfortunately, because my time is also limited, as for everyone, I cannot stay awake the entire night and the entire day. I live in Europe, and so I provide these contexts only during the European session. So starting with the London Open, ending with the London Close, and if necessary, when we have a Fed announcement, for example, an important US announcement, I can extend my session until these important news release in the second half of the US session. And so this service will be made on a fee basis. So we start with a trial period. The fee will be, I think, $27 or $29 per month. But after the trial period, we will reevaluate the price, and we consider that this kind of context information should be available to everyone, not only to our Max member and students, but also to everyone who are interested to trade in agreement with the context. So after a small period of time, we will open this service also to any traders who are interested to trade in agreement with the context. So this is what the max bias will be, and based on all my experience for some time now, these directional contexts are correct in 80% and sometimes more than 80%. Some days even 100% correct context. And so this allows, for example, to avoid unnecessary trades or bad trades. A bad trade is a trade taken either with an error or against the context. And when we have a bad trade, this is a question which has been asked, how can we avoid to take bad trades? So focusing on the context, taking the trades in agreement with the context. Unfortunately, when we have taken a bad trade, we cannot always repair that trade. The best way to do, on my opinion, is when we realize we have taken a bad trade, close the trade immediately. This is often the best approach to do. So never count on hope to have a bad trade becoming a winning trade. We cannot count on hope or luck to become successful over a long time period. So, okay, now we can answer all the questions which have not been answered for the moment. So, and I will come back to the previous page.
Okay, thanks, Eusebio. Just regarding the new buyer service, when it comes out, you should be able to, with any other trading system, use the buyer service to help you get aligned, just like you can use our Newswatch to avoid sticky times in the trading day and to pick the best pairs. So it's not Max, particularly Max specific. It'll help pretty much any other trend trading system. Some of the questions that have come through have been, Bruce asked kind of specific questions about crude oil. He's asked how many entries can, sorry, I'm just trying to find it here. It keeps jumping up with all the other questions. Okay, there's a whole pile that I've not seen yet. Okay, Bruce's. I don't hold positions overnight. Can you tell me how many crude oil intraday entries the prime signals would generate, the primer would generate on average? One or two, just by looking at the chart, Bruce, if you're trading it through the US session. I didn't bother checking out the London session, but it's one or two. And you also asked, what is it? Where is Bruce? Sorry, I have to scroll up and down here to find the things. Okay. Bruce, do the scaling indicators work in replay on NinjaTrader? I think they will, Bruce. I haven't heard anybody saying that our indicators do not. We don't have scaling indicators in particular. We have setups that appear. So we have a set of indicators to help us find the best time to enter and exit, but we don't actually have indicators which fire off and say get in now or get out now as such. And for those of you interested in other trading platforms, like I said, we do have some of the indicators for Ninja 7, Ninja 8, multi-charts, TradeStation, I think, but I think they've also moved ahead, and what we do is we rely on some of the members to say, hey, I've got these indicators here, and they work with the Max. The Max indicators are pretty generic, so with most of our indicators, all the other platforms will have them. If they don't, we're more than happy to give you the source code so that you can port them over to you can recode them into your platform, and a lot of people have done that, so there's no problems on that side of things. And if there's an issue with it, we're more than happy to help. There was a question about, I'm in New Zealand, what's the support like? Well, the sun never sets on the Max. Where did I see that one? Sorry, there's just a whole pile of questions that pop up. Okay, Ricky asked, New Zealand is quite away from us. What are your customer support hours in GMT? 12 hours directly opposite. But there's not just me. I'm in New Zealand, so I cover the time from about 4 p.m. New York time through to 3 a.m. New York time. Craig is around from about through the US session, and Eusebio is around during the European session. So we've kind of got 24-hour support if that's what's really required. Generally not needed though. So we're open kind of 24 hours essentially. Okay. And
but of course, when we are trading ourselves, we trade first, and then if there are questions to answer, yeah, when we answer the question after our trading session. So when I don't trade, I'm available to answer any questions. So.
Yep. And can NinjaTrader be used? Yes. If we don't hold a position overnight, another question from Bruce. If we don't hold a position overnight, will we still be able to enter and scale the standard trades in futures, crude oil, and the ES? Eusebio, do you want to answer that one?
Okay, can you repeat the question, please?
Okay. if we don't hold positions overnight, will we still be able to enter and scale the standard trades in futures? And Bruce is talking particularly about M5 timeframes or intraday stuff.
Yeah, you can. In fact, if you want to avoid the day separation for any reason, you can close your position before the end of the day, and then after the open of the next day, when it is appropriate, because sometimes when it is not appropriate to trade, you can reopen your positions. There is no problem for that. This is the way to handle a trade. In fact, in the Max Advanced course, I was teaching that approach in the Forex. Nowadays, most of the time when we trade with a small time frame, 5 minute, 15-minute time frame, we don't keep our trade overnight. So once a trade is closed, we forget that trade and we will consider the next trade as separate trades. But yeah, it is possible. So.
Okay. Bill has asked, are we taught how to trade for ourselves, or is this software purchase and trade recommendations? No, we train you how to trade for yourselves. There are no red, blue arrows popping off all the time or anything like that. With the bias, we're getting closer to red, green arrows, but in a trend you can have short setups and long setups, even though the long-term bias is saying to go long. So with Eusebio's help with the price levels, the news watch, the pairs to pick, and his biasing in the charts, and his global one that's coming up, you'll be in a much better position to be able to know which direction to pick your trades. Even though you might get a setup in the opposite direction, you know it's more risky if you take it, if you ignore the long bias signals. So, okay. Okay, what's the difference between the ETF programs and the courses of several years ago? That's a question from Jay who's left.
That's a good question, and the difference is the following. And for that, I will make a small drawing on my screen. Let me take my pen here, and let me choose an appropriate color. So just a moment.
While you're doing that, the short answer is there are a lot more entries with the new ETF version that Eusebio has developed, both long and short in the like 4 to sometimes 10 times more entries in the same time period that the old Max would have. Sorry, Eusebio, back to you.
Yeah, let me see if there is an appropriate example here. So this is an example. In the past, with the Classic Max, we call it the Classic Max, when the price is moving below the home base, we would have considered only short trades. So we would have exploited only that movement, ignoring this counter trend movement. So with the Classic Max, we were exploiting only trades in that portion of the trend. And this has been a situation which I have found very frustrating, because the trend starts in this area. And so the introduction of the ETF concept is now we can consider that entire movement as an entire trade, and we trade that movement independently of the home base. However, the home base is still an important line, because the price reacts in a very specific way around the home base. So this is the main advantage of the ETF concept. We recombine into a unique larger trend, and so and with many more opportunities to trade. So counter trend movement, classic counter trend movement, and classic trend.
That's it?
Yeah, that's it.
Sorry, sometimes you pause and then you start again. I'm not too sure. Okay, thank you. Okay, another question was from John. This one we get asked all the time, and we always get the same answer. How long does it take the average person to become a confident trader once they've completed the standard course? It's really hard.
There is no fixed answer for that question, because it depends how much time you can dedicate, for example, every day. If you are able to dedicate every day, let's say half an hour or 1 hour, in a short period of time, you will master the max. If you are able to dedicate only 1 hour per week, you will take a longer time. So it depends on you and how you organize to assimilate all the concept and rules and to practice. So
other things that come into play are, where do you live? For instance, I live in New Zealand, and I only get a short window of really good trading opportunity, which is generally the London morning. and that's it. Anytime after that, it's midnight for me. The US session is pretty much over and done with by the time I wake up. So if you only have a brief period of which to actually trade in, it limits your all the extra opportunities that you get to see sort of reasonable moves as well. So there's all sorts of factors that go into this. Need to know more about your situation. He's also asked, how complex is the method to learn? Craig has already answered. Sorry, complex compared to what, John? There is a lot of information in the Max, even in the primer. So that there is quite a bit of detail, and yeah, sorry, I need to know what you're comparing it against. Bruce has also said, I've been a student with person X for the past 2 years. Will the standard system complement his teachings?
Yes, sure, Bruce. It complements nicely in some kind of, not all the trades, because I know, of course, the person you are mentioning. The Max will complement nicely the type of trade which is called the moonshot trade. So, in fact, the trend trade, in fact. And so, yeah, it's a nice combination, in fact.
Yeah, and Eusebio jumped in on was invited to another training person's forum as well, and showed how he could use the Max to boost their results too, and ended up with thousands of pips. Sorry, I know it's from one trade. It sounds a bit outrageous, and we tend not to sort of talk about it, and I let that slip. But Eusebio is a pretty amazing trader, as well as developing the courses, and pulls out some pretty eye-watering numbers at times.
Yeah, there was an important point to consider, Bruce, and you in particular, because you have mentioned that person, you will understand what I mean. It is often said that to be successful in trading, we need at least an edge. What is an edge? It's an advantage we have against the other traders, perhaps by better understanding how the prices are formed in the market and what are the factors moving the market and when. So, and it is often said that the retail traders, because of a lack of knowledge, have no edge against the professional traders. But in fact, when we consider the retail space, the retail traders have some edges against the big traders in the banks or in the hedge funds. So they have the flexibility. And that flexibility can make also a big difference. A big trader cannot engage, for example, $500 million, $1 billion at once in the market. He is forced to split his trade into smaller portions to get, in fact, average prices. The retail trader, because he will trade smaller or she will trade smaller sizes, has the flexibility to enter in a more easily way in the market, provided, of course, the retail trader has a good knowledge of what is happening. And so, yes, so the kind of trade you know, some of them, in fact, the trend trading system you know, or approach you know, are nicely combined with the Max.
Okay, somebody has asked, are the indicators being ported to Forex Tester number 2? I think they have been, David, but they were ported several years ago when version 2 first came out, and we've made modifications to them since then. So, and we've kind of moved away from Forex Tester onto different testing platforms. So I think what Forex Tester, sales for them, do is they will port the indicators for you if you need them changed from MetaTrader to Forex Tester. Is a way of getting more sales for themselves. Okay, and
there has been a question you have missed by John. I no longer see the question, but what are the best pairs to trade during the US session? In fact,
Marco.
Marco, yes, this is a good question, and there is a very simple way to answer that question. You know that each pair is made of two currencies. I will note that X, Y, X being the base currency and Y being the quoted currency. For example, euro, US dollar. Okay? And so the euro is one of the 3 European currencies. For the European currencies, we have the euro, we have the Swiss, and we have the pound. And then we have the American currencies. We have the US dollar and we have the CAD. And then we have the Pacific currencies with the yen, the Aussie, and the Kiwi. And so each group of currencies represent one session. The European currencies represent the European session, the American currencies represent the US session, and the Pacific currencies represent the ASEAN session. And so when you have a specific pair, the pair is made of 2 currencies. And so this means that the currencies themselves tells you which are the best, often the best appropriate sessions to trade that pair. For example, the euro US dollar is made of a European currency and an American currency. So the European and the US session are the 2 best sessions to trade that pair. If you take a pair like the Aussie yen, the Aussie yen is made of 2 Pacific currencies. So the ASEAN session is the best session to trade that pair. But don't forget that the sessions are also overlapping. You have the ASEAN session that way, which overlaps with the European session, and the European session itself overlaps with the US session. So during the overlapping pair, you may have more pair to consider. Now, if you consider our news watch list, in fact, page, as I will show it again, and you have the top 10 or the recommended pair per days, depending on your session, you can further fine-tune the pair you want to monitor and trade. For example, on the Wednesday, if you trade during the US session, you can trade the pound Kiwi, the pound Aussie, the pound CAD, the euro Kiwi during the overlapping period between the US session and the US session. And during the second half of the US session, when you have unfortunately less opportunities, you will consider only the pound CAD because it's only the pound CAD which contains an American currency. So, okay, so I hope this answers your question, and it is a very simple way to define most of the time which pair to consider. But there are exceptions due to the context, due to the news release, due to any event which may impact the market. So,
okay, thanks, Eusebio and Marco. And the last question is here from Bruce. I trade only futures. During the standard course, will I be able to follow the Forex trades by using their future counterparts, where there is one, such as 6E for the euro dollar? 6B,
oh yeah, yeah. Of course, we have. I know some of our max traders who follows, who trade, for example, exactly as you have said, the euro US dollar, but he makes his analysis on the 6E. So on the futures contract, he makes all his analysis on the 6E, and then he trades the euro US dollar on the Forex. So for reason he has personally. So yes, you can make your analysis on the Forex and trade on the futures corresponding contract, or make your analysis on the futures contract and trade on the corresponding pair in the Forex. So the 6E for the euro US dollar, the 6B, I think the 6B is the pound, the 6A is the Aussie, and so on and so on.
Okay, I think that's up to the... Oh, sorry.
Knowing that there is a difference between the price of the futures contract and, if we take, for example, the 6E, the euro against the US dollar, and the euro US dollar on the spot forex, there is a difference in price. The difference in price is directly related to the interest rates remaining to pay until the expiration day of the futures contract. The interest portion of the price will decrease with each day and will be 0 on the expiration day. And so this difference explains also the difference between the 6E and the euro US dollar. And what we observe sometimes is the futures contract will lead the Forex, but sometimes the Forex will lead the futures contract. So don't try necessarily to use one to anticipate what may happen on the other. The anticipation, the leading or the lagging aspect is not systematic.
Okay. So I think we've done enough here. If you have any questions, please feel free to send them in to us by email.
Chris?
Oh, Craig?
Did I miss Miguel's question? Did you guys address that?
No.
Okay, I will read it. I will read it, Chris. So the question is there any way to repair a bad trade, and can I learn to avoid getting into bad trades? Yeah.
Sorry.
So I have already answered partially that question. So is there any way to repair a bad trade? In fact, what do you call repairing a bad trade? If you consider some techniques to transform a losing trade into a winning trade, my answer would be forget it. As soon as you have realized that you have a bad trade, close your trade and forget that trade. And you will have a bad trade for any reason, because you have made an error, you have not recognized correctly a setup, you don't trade against in agreement with the correct context. Now, how to avoid getting into bad trades? Precisely by choosing the trades in agreement with the context. And the context contains several aspects. As I have said, the news release, the central bank decision, their daily operations, the geopolitical events, and when we day trade, some critical time period during the day. There are some times when it's better to close an open trade or to avoid opening a trade. For example, typically, this is not always 100% sure, but typically during the European session lunchtime period, so the price in all the European pairs are slowing down, it's better not to enter a trade, except if there is a good reason for that, which depends on the context. So avoiding bad trade consists essentially to understand the context and to take the trades only in agreement with the context. So you will avoid many bad trades. You will not be able to avoid all of them. From time to time you will have one, and you have to accept that, and sometimes you will miss a good movement. But a good movement does not necessarily mean a good trade. You need also to know, for example, that in the Forex, you may have a pair moving, a cross pair, for example, let's say the Euro-Pound. I take just an example, the Euro-Pound, which is a cross. So that pair, we can see the price moving, but with no trade at all. And why a pair can move without no trades? Simply by the concept of the rule of the fractional disparity. And with the fractional disparity, you know that the Euro-Pound is linked also to the Euro-US dollar and the Pound-US dollar. If there are trades on the Euro-US dollar and on the Pound-US dollar, automatically the Euro-Pound pair will adapt automatically, without trades on the Euro-Pound. And so this is the mechanism you have to trade, and so this is why the context is important, to know in which pair the movement will happen. So, and you can trade, of course. Okay, that was my answer, and I hope it's clear enough.
Okay. Right, so let's have another shot at closing this up. Yeah. Thank you very much for coming along, everybody. And if you have any questions, please ask. We're available on Skype as well if you want to quickly jump on there and hit Max Trading System. I'm around most of the time. Same with Craig. We're monitoring it. So just ask the questions and we'll be here to answer. Thank you very much.
I will leave the slide open for 2 more minutes. I will close the room in 2 minutes. So if you need to take notes of these links, so please do it. You have also the link in the chat area, so you can make a copy of the link if necessary. Thank you for your participation, and see you soon in one of our courses. So bye everyone. Have a great rest of the weekend, and so take care.